Good morning, everybody, and welcome to today's Monday morning mortgage rate update. My name is Sean Wohland with the Wohland Mortgage team here at Waterstone Mortgage, and I'm going to jump right into it because we had a lot of confusing reports last week, and a lot of people think mortgage rates got better. But before we get into that, I want to go into our loan product spotlight. So we've got a program that we have internally called the Momentum Program. And essentially, if you've got a buyer that has a contingency to sell their home, this program will allow us to remove that contingency and purchase and make an offer with no contingency, even if they do have a home to sell. So it's a fantastic program, eliminates those contingencies, and gives us a really great upper hand on making an offer. So exciting news, exciting program, basically same as cash. Is also available, but you talk to me more about this. It's phenomenal. There's a lot of details I need to explain about it, but definitely give me a call to go over this in detail because it can absolutely help you get into a property with no contingencies. So last week in review, we had the Fed cut rates by a quarter, and then the Fed hinted at potentially 0 cuts for December. So that kind of spooked the market. So mortgage rates actually rose 50 basis points. Now 50 basis points in price, BPS, not D, don't know why I did that, but 50 basis points in price. So a rate on Tuesday that didn't cost any points to get, that same rate the very next day cost a half discount point, that's 0.50 discount points in cost to get the same rate. So the pricing got worse, which means rates got worse. Rates spiked a little after Powell's comments. Not fun, but we'll go into that in a little bit more detail. Government shutdown is still in effect. So because of that, we don't have the data that we typically would have for like jobs numbers or other things that could potentially help mortgage rates. So weak jobs numbers that are definitely part of the equation are not being reported, so it's keeping rates high. So that was last week in review. This week, calendar events is boring because we do have a government shutdown. Sorry, we're closed. No data means not much going on. So we have ISM manufacturing numbers. Tuesday, nothing, zilch, nada. Wednesday, we do have private party ADP numbers coming out for jobs. They expect 25,000 new jobs. That's it for the previous month. That's bad. That's really low. So we're expecting that could potentially have a good impact on mortgage rates. We do have ISM non-manufacturing coming out on Wednesday as well. Challenger job cuts on Thursday. Bank of England and their decision on rates on Thursday as well. And then on Friday, consumer credit change. We'll see how consumers are doing with their credit. So interesting week, very boring, not much going on. And here it is, because of lack of data, they are unsure of any future rate cuts this year. So because of what Powell said on Wednesday, mortgage rates got worse. So basically, he took away the potential of a future rate cut. And guys, when we hear the Feds talking about the next meeting and what they're going to be doing with cuts, the markets react at that time. So this 25 basis point cut that we got on Wednesday, it was almost 100% guarantee, and we knew that a couple weeks in advance. So the markets already priced that into the mortgage rates. So when the Fed cut by 25 basis points, nothing happened to rates. They stayed the same on the mortgage side. However, once he opened his mouth and what he said, that's what hurt the markets. So he took away the future rate cut, or at least he gave a hypothetical of maybe we won't do one in December. And because what he says and the future rate cuts are baked in now, not when they actually cut, the markets moved in reaction to that. So not a good day on Wednesday. We lost a lot. Everyone's confused. They think, oh my goodness, the Fed's cut the rates. They think mortgage rates are going down. They don't have any impact on each other. The reason being, the Fed funds rate is the rate at which banks borrow money overnight, 24-hour money. Mortgages are 30 years, not overnight. So different things impact them, like long-term bonds. The bond market got hurt. That's why mortgage rates went up. So It's an interesting relationship between the Fed funds rate and mortgage rates. They do not go hand in hand. So where are we? Other than my allergies kicking my rear end, this is what we were talking about. What will the rates do when the Fed cuts rate? And this is what we got. So we wanted him to talk about how employment was continuing to show signs of weakness. He did not say that. We wanted to talk about inflation dropping. He did not talk about that. We wanted to talk about halting the runoff of the balance sheet. He did talk about that. However, he did continue to be hawkish about jobs, saying they were pretty strong and normal. He said he's still worried a little bit about inflation with a little bit of the tariffs and no future cuts because we don't have any information. So that was all bad for rates. That's why we saw mortgages spike. So where are we? Well, you can see right here, this is the effect that we had last week. Wednesday was this big move downward in red. We were looking really good. Remember I talked about we wanted to pierce above this Fibonacci level? We went right up to it, stopped, and then boom, all the way. Same thing, happened a couple weeks ago. In September, we tried to go above this, and boom, we got kicked the other way. If we go back further, this line in the sand, this Fibonacci level has been very stubborn. We have not seen the mortgage-backed securities pierce above this level in many years. So it was hard pressed for us to get above this. I thought we would. Unfortunately, with what he said, or I thought we could, we went the other direction and got worse. And now we're below the 25-day moving average. We went below the 50-day moving average and stuck. That's partly because the 10-year is holding us on their Fibonacci level of, their 50-day moving average. But look, we're right above it right now. So not good right now. Look at how the 10-year has risen in the last 2 weeks, the last week and a half. It's really on the rise, which means mortgage rates are on the rise. Hopefully, we will get some employment data this week to bring them back down, but we're still decent. We're in the low sixes for standard 30-year fixed conventional. Remember, this is based on a very good borrower, 25% down, 780 credit score, single family detached home, owner occupied property, 6.25, 6.28, no points typically. And then on a 15-year, you're at 5.81, which is great. You're in the fives on a 15-year. So if you can get your customers to think about a 15-year, that will save them a ton of money. And then jumbo right around the same as the conventional 30-year. And then ARMs breaking under 6. And then FHA and VA just above 6. So not terrible, but we are higher than we were. And I thank you guys for tuning in today. We are the Wohland Mortgage Team. I am Sean Wohland. Thank you so much. Have a great week. And if you need anything, here's my number, 480-322-4544. I'm here to serve. Thanks, guys. Have a great day, and we'll talk to you soon.